Thank you, Akshara. I'd also like to invite my colleague Sunil. Sunil, would you like to come on stage, please? Uh, Thank you, PMS Bazaar, for this opportunity. I was very delighted to hear that this is the first ever conclave that PMS Bazaar has launched, and I'm very thankful for the response. You've come on a holiday. I think the traffic was suspected to be a little bit on the rougher side because Prime Minister Modi is going to be in town. But thank you so much for coming by and listening to the entire fraternity. I've been very keenly watching some of the presentations which have been made. It's indeed a space which is growing very fast. I'm talking about alternates. And it's something wherein mutual funds were 30 years ago. Everybody knows the advantages, but people want to know a bit more. And I think it is the job of people like us to keep talking to you. Let's talk about the India growth story before I hand it over to my colleague Sunil. We all talk about an opportunity which is coming up in India in terms of trillions of dollars, 5 trillion, 7 trillion, 10 trillion, and we also talk about a certain time frame. The good part is that the trillions increase and the time frame in which we are going to achieve that keeps decreasing. I think that is the amount of positivity which is there in the country right now. But what is important enough to know is what is going to drive that growth. We all know conventional avenues like debt and equity, but equally, private equity and private credit have come up in the recent last few years. Private credit in particular. It's estimated that if India needs to grow at the pace at which it is growing, close to $50 billion worth of private credit opportunities are likely to come up. Now, there are two ways to access private credit. One is at an institutional level and one is at a retail level. At an institutional level, most borrowers would want to come earlier to banks, then NBFCs, and now AIFs, wherein AIFs can actually structure the product as per the borrower. We've had a very a good success in our performing credit funds and the real estate funds, wherein we've drawn down ahead of schedule. However, as a retail person, you have to wait for a primary issuance coming in from the manufacturer. For example, an Edelweiss or an ICICI Securities launches a public bond, a bond for the public. That is when you can access. I'm just oversimplifying things. So where is the gap? The gap for a retail investor, earlier it used to be filled by mutual funds. You could invest lower sums of money in mutual funds and they in turn would act as institutional players and invest in debt instruments. Now it's debt PMS. This is one of the fastest growing segments at this point of time. There are two ways to make money in debt PMS. One is basically playing on the interest rate scenario. You're going to be holding the money for 3 years. But more importantly, one of the ways you make money in a debt PMS is credit upgrade. What I'm going to request my colleague Sunil to do is talk about a debt PMS, which frankly we're launching on Monday. It's not even launched yet. So this is probably a pre-launch sort of a presentation for us. So thank you so much for your time, and I'm going to ask my colleague Sunil to take over. Sunil, over to you.
Thanks, Vikaas sir. Good morning. We all are familiar with debt products, the conventional debt products like FDs, mutual fund, debt funds, which offer liquidity but low returns. And on the other side, we have products in the credit space in the AIF platform, the credit funds, which offer substantially high returns as compared to the conventional products, but with very low liquidity or zero liquidity. So there is a gap between these two segments. So the product that we are launching, as Vikaas sir said, the debt PMS, it actually fits or fills the gap which is left by these two segments which I spoke earlier. So a debt PMS wherein the investment is made in rated and listed securities. So how does this product fills the gap between these two segments? I won't take too much of time. I'll quickly brief you what would be the feature of the product. And so how does the yield, when I say the earlier conventional products offer liquidity but low returns, and the credit AIFs offer high yield but low liquidity, this mismatch is more or less to a larger extent is filled by this PMS. So how does it happen? So in PMS, how the yield is better than the conventional product is the portfolio will have a mix of securities which has ratings ranging from AAA to BBB. And in the fixed income market, the interest rates offered in this range of rated securities somewhere between 8 to 12%. So that's the range that we have. We have the availability to invest in debt PMS in the rated space. So a combination, a blended portfolio of securities rated AAA to BBB will offer a higher coupon, higher interest as compared to a traditional product like FD. At the same time, since the investment will be in listed securities, whenever there is a rate cut cycle happening, fund manager will get opportunity to book capital gain, which will add to the returns generated by high coupon. So a combination of high coupon and capital gain is the reason why we are saying this will have a better returns than a traditional investment, which is a bank FD kind of product. At the same time, the risk mitigation factor also needs to be looked at, and the important thing here would be the credit analysis done by the fund management team. The professional fund management team, not only they have the ability to do the credit analysis, also they have the ability to look at the liquidity available in the debt market, the tenure of the bonds, what they want to invest in, and make a portfolio of around 10 to 15 NCDs or the corporate bonds available, so that the gap which I highlighted, liquidity and enhanced returns, can be filled in. So an overview on the product, as I said, it will have almost 10 to 15 securities, so which will provide diversification, which will take care of the concentration risk and also provide the liquidity in the portfolio. So wherever there is an opportunity, the fund manager, depending on the liquidity on these papers, can exit, and also the investor will also have the opportunity to exit the fund which otherwise is not available in a credit AIF space. Risk management, as I said, the thorough credit analysis is a very important thing in these kind of products, which the fund management team is capable of doing and will take care of the risk mitigation thing. Income generation, I would say this is a very important feature of this product, because the regular coupon payment to the investor is a very important reason why an investor should come into this product. There are a lot of investors who seek regular stable income, so the coupon from the underlying securities which will be paid to the investors regularly will be a very important reason. That is the reason this product will appeal to a large section of investors who require or seek regular income, regular and stable income. Being a PMS product, transparency and regular reporting is part of PMS product. The investors will have access to the portfolios, their performance, the transaction details, the fees and expenses. So transparency and reporting are inherent to the PMS product. So now what are the benefits? Basically, the traditional products like FDs, we have mentioned what are the features of each and every product, and every product comes with pros and cons, advantages and disadvantages. The last column, which is of debt PMS, the risk and the moderate the liquidity, moderate liquidity, the high yield, and the last line which says marginal tax rate, because interest will be has to be the tax on interest will be paid by the investor. But whenever there is a capital gain instance, because these are listed, and if the fund manager is booking a profit from a listed bond after 12 months, the capital gain is 10%. So a combination of these factors, especially the moderate liquidity, high yield, 9 to 12% is the range of returns that a that investor can expect, plus the combination of capital gain instances which will slightly break down the tax liability. These are the advantages of having a debt PMS in the portfolio apart from the other products which conventionally people are investing. This is just a rough calculation. How do, on what basis or how much returns fund this PMS is expected to deliver post expense. So the FD, the SBI FD, 3-year FD is what we have considered. The debt fund is a credit fund, average of the credit funds YTM that is available post expense. So if you see net of the expenses, net of tax, there is almost more than 200 basis point difference between FD and debt funds. So this is because in fixed income market, 200 basis point, 300 basis point kind of difference is a substantial difference. So this reason is good enough for a HNI or for a corporate to look at this segment of product, and it's a upcoming product, actually upcoming segment I would say. Not many products are available in the market as such. So this is a good segment which fills in the gap that was left void for a longer period. This question will be asked, is whether this is the right time, whether we are coming only because the interest rates have peaked. The answer is no. In any prevailing interest rate condition, this product is expected to deliver higher returns than the conventional debt funds. So it is an all seasons product. At the gross level, 300 to 400 basis points is the outperformance that we expect or target that the fund will deliver over traditional products. So just an information on the debt market, there is a credit edge debt quality index which shows us the quality of debt. So if you see the graph, it is gradually increasing or improving, I would say. So the value which you are seeing now was last seen or available almost a decade back, 2014. So after 10 years, the quality has reached to the same level, and the graph clearly shows it is improving. So it's a positive sign for the overall debt market. So this just this fixed income rated short term plan is the name of the debt PMS. So we have just shown where all we are investing. The underlying investments will happen in non convertible debentures, corporate bonds, commercial papers, and preferred capital. It will be a combination of these. It's not necessary that that portfolio will have securities from all these segments, but this is a universe which we would be looking at. This is the offering of the product. If you can see, predominantly hold to maturity is what would be the style of investment, and in a falling interest rate scenario, the fund manager at a right opportunity might look at booking profit and add to the overall return by booking the capital gains. The universe of security in terms of ratings would be AAA to BBB. So there will be different combination exposures, a percentage weightage will differ for each rating. Then average duration 2.5 to 3 years, because that is what we feel is the right time horizon where you can have an optimum returns from a debt instrument. And since it is a PMS product, the minimum ticket size is 50 lakhs, unlike a credit fund in AIF where one has to invest minimum 1 CR. And as I said, the liquidity is an important feature where it scores over a credit fund. There is an exit option available for the client to exit before the 3-year tenure as well, obviously with exit load, but that liquidity option is available. So this is what is about debt PMS that we are offering. Thanks for patiently hearing.
If I can just supplement what Sunil made in this wonderful presentations, there are 3 reasons why this product should be considered by you. One is asset allocation. An investor needs to have debt in his portfolio, and with the interest rates going down or expected to go down, I think this is one product which will fit in very neatly. The gap used to be filled by debt mutual funds earlier, but now with indexation benefit gone, it's basically how smart your fund manager is, which is what is really going to count rather than any tax arbitrage. That's the second reason. And the third reason is our DNA is credit. Sundaram Finance is our parent company. They manage independent books of these sort of bonds on their own, we will be leaning on them for their expertise. But I just want to give you the comfort that credit is in our DNA, and that gives us probably an edge over most other players. This is an upcoming segment. I think the current AUM is around $1 billion at this point of time. But I believe that the time has come for this product, and one should definitely give it a closer look. Thank you very much for your time.